Jim Carr is the Chief Operating Officer for the National Community Reinvestment Coalition, here with us to talk about refinancing folks' mortgages, and particularly those who are underwater or in trouble with their mortgage. I wanted to point out a chart in Sunday's New York Times about interest rates. Low rates is their chart. A peak of this chart in the mid 80s and 80s into 90s, and now the chart numbers, the interest rates are at historic lows, going back to World War II. Why can't folks get refinancing with rates so low?
Well, there are a number of reasons, Bill. First and foremost, the number of households who are underwater, meaning that their mortgages now are currently worth more than the actual value of the homes, is at an historic high, almost 25%. So that is a major problem. In addition, the lenders have really tightened up in terms of what they require for consumers to actually refinance a home. And so we have gone from a period of really reckless, irresponsible lending where consumers didn't have to provide any information, literally. They just simply state their income, state their assets, and get these loans that were not sustainable, to a point where now the lenders really are not in that position at all. They've gone actually way to the opposite end now. You have to have a very high credit score, you have to document everything, and particularly for those consumers whose mortgages are upside down, the houses really have lost value pretty substantially, they're in trouble.
I wanted to take a look at some of those numbers too. The Washington Post had an article last week. Foreclosure relief program is stuck in first, and some of the figures that came out of that, about 31,000 or 4% of the 728,000 people in the program, the Making Home Affordable program, have modified their loans. 30,000 homeowners have been disqualified. That number, that 728,000, you're with the National Community Reinvestment Coalition. Is that a big number? Should that be a lot higher?
Bill, that number needs to be many, many times higher. This year, we are en route to an unbelievable 4 million foreclosures just this year alone. Just this year.
How's that compare to other years?
That compares to a normal year, which would have been about maybe 300 or 400,000. But in recent years, the numbers have been just unbelievable. Last year, 3.2 million foreclosures. So we're talking a foreclosure crisis that is not only astronomical in terms of absolute numbers, but it's still growing. And when you dig under that number of 4 million, in fact, you see that, in fact, we could even have more foreclosures were it not for a number of the programs that are being put into place that are creating moratoria on foreclosure. So if those moratoria weren't in place, if those loans that are currently, for example, you mentioned the administration's home ownership modification program, a foreclosure mitigation program, if those don't convert to long-term or permanent loan modification sustainable, you can add those to the pile of foreclosures as well.
We want to get our viewers involved in the conversation on home mortgage refinancing. 202-737-0001 for Republicans, Democrats. It's 202-737-0002, and Independents and all others, 202-628-0205. The House on Friday passed a financial regulations bill. One of the amendments that was defeated was an amendment by John Conyers and others that would have allowed bankruptcy judges to write down or to adjust mortgages. Would that have been a good thing?
Bill, that is one of the most powerful tools that could actually move this foreclosure crisis forward in terms of modifying loans. Essentially what it says is that a home would be treated like any other major asset, a luxury yacht, a rental property. It says that in the event that you're struggling to pay your mortgage, you have access to a bankruptcy judge. And that judge, we're not talking a consumer advocate, we're talking a bankruptcy judge, would be able to look at the consumer's perspective, from a consumer's perspective, from the lender's perspective, and strike a reasonable deal that will allow them to maintain their home, at the same time be something that's working in the interest of the investors as well. That was defeated. The problem is that that law alone could resolve as much as 30% of the foreclosure crisis at no direct cost to the American taxpayer. It's what the administration asked for in the beginning of the year when they put forward their Making Home Affordable program. Congress almost passed it, the House passed it, the Senate didn't. And that was a real loser for the program, because that was the compelling aspect. We have incentives in place, but we don't have anything to compel behavior by the servicers, and that's our problem, or a major problem.
What would you like to, specifically, what do you see as the most, the strongest thing that could compel servicers to modify the mortgages?
I think if the servicers knew that there was going to be a third party that could intervene and take a look at that consumer's circumstances and not just give everything away to the consumer, but look and on balance say, this makes sense to the consumer and it makes sense to the investor. If the servicer knew that a consumer had that recourse, they would be much more efficient and effective at evaluating those loans and either approving them or not approving them. But what we have right now is just complete intransigence in the system.
Are you getting some cases where a mortgage servicer or provider sees it's just cheaper to let this thing go to foreclosure rather than modifying the mortgage?
It's not so much that it's cheaper to let it go to foreclosure, it's that the servicers are allowed to collect a whole host of fees as the loan goes to foreclosure, and then ultimately they collect during the foreclosure process. There are lots of incentives, financial incentives, and they're reasonable financial incentives, but they can't compete with the enormous number and amount of fees that a servicer can stack up by just sending a consumer through the tortures of foreclosure. That's why they need a reason, a compelling reason, and that way you have, here's an incentive and it makes sense, the financial incentives are good, but here's a compelling reason that says we need you to understand we're in the middle of a national crisis. And Bill, if I could just say one other thing, there's so much talk about a recovery, right? But it's a jobless recovery. That jobless recovery is not a recovery in the sense that it is unemployment, which is the largest driver of the foreclosure crisis now, not the bad products. They've kind of worked their way through. We have a whole new set, by the way, that will be coming next year. But right now we have foreclosure as the largest driver. So as long as the problem that caused our crisis in the first place, which was foreclosure crisis, continues to get larger and larger, and it's taken on a life of its own now, then we won't really recover until we get people back to work. We won't get them back to work until we resolve the foreclosure crisis. You see, it's very circular, but that's where we are.
Caller waiting for you, Walter, a Republican, Leo, Indiana. Go ahead for Jim Carr.
Good morning. Thank you very much for taking my call. I appreciate it. I came from old school. My mom and dad always said the first person you pay is yourself. You take 10% and pay yourself. You don't need a new car. You don't need fancy clothes. You need viability. You need security, and that sometimes means that you have to go without for the longer purpose of.
Hey, Leo, I'm gonna let you go. We do ask our viewers to give us 30 days. Give us 30 days between calling this program. Stevenson, Michigan. Fred's up next on our Independence line. Hi, go ahead.
Good morning, Jim. I think you've said a lot of intelligent things to this point, and I agree with all of it. You kind of answered my question while I was on hold, or my point. I think so many people don't have jobs right now, and correct me if I'm wrong, but I believe it's now a requirement that you have to have a job to even get one of these program or loan programs. You know, no job, you might as well not even apply. And I just was curious. Your program's called Community Reinvestment Coalition. You know, you touched on the irresponsibility of lending practices that led up to this. And I mean, if you go back to the community reinvestment in 1977, and then how it was, everything was loosened, and banks were forced to loan irresponsibly, and then the government stepped in and backed everything with Fannie and Freddie. And I mean, it was just a snowball that rolled downhill. And I mean, we see where Christopher Dodd is in the polls. He was in it right from the beginning, all the way through getting those loans with the sweetheart loans, you know. So I mean, you seem to have the same name, but you don't seem to agree with what went on. And now our government is continuing to borrow and setting poor examples. And now I think they're trying to make people or businesses take loans that they probably shouldn't be taking, you know. So, I mean, where's the good example from the government?
Thank you, Fred.
So you've raised a lot of issues. Let me just walk through a few. So one of the reasons that, you know, we hear so much about the reckless loans, and most people now really have come to understand that there was a lot of irresponsible lending, but they're aiming in the wrong direction. They're aiming at the community and the borrowers as opposed to the financial institutions that offer these bad products. So, for example, you referred to the Community Reinvestment Act. The Federal Reserve Board actually did a study last year because they wanted to purge that misperception that was being offered in the market. Only 6% of these problematic loans, 6%, were actually covered under the Community Reinvestment Act to low and moderate income households. Again, 6%. So almost 95% had nothing to do with that act. In fact, it had to do with Wall Street investment bankers and others who were not covered under CRA. And then the second thing is about the government's irresponsible spending right now. I absolutely understand your concern about the deficit spending. We are in a mess. But here's the problem. The problem is, how do you get out of a recession? The best way to actually pay down the debt is to have people employed and actually paying taxes. And so the question is, how do we get people back to work? Even the most optimistic economists right now are expecting these high levels of unemployment to last for the next 2, 3, 4, as many as 6 years. And so that is one of the reasons why the deficit spending, if it's actually creating jobs, would be the most powerful way to reduce the deficit. But if it's spending for miscellaneous and frivolous activities that don't create jobs, I'm completely with you. We're just digging ourselves a deeper and deeper hole.
Next up is Jason in Rock Falls, Illinois. Go ahead, Democratic caller.
Hi, how are you this morning, gentlemen?
Go ahead, you're on.
My question is if they're lending $3 or $4 on the dollar to the consumer or the homeowner or the person who's actually getting the loans, isn't that the practice? Isn't that a little? Why isn't there a regulatory system behind the banking institutions lending $2, $3, $4 on the dollar to keep more people in their homes?
So I'm not exactly sure what you mean by the question of lending $3 or $4 on a home to keep their home. One of the things I can say is that the programs to address this financial crisis have been upside down from the very beginning. And what I mean by that is, going back to last year, when we realized the banking system had a problem and the banks were beginning to fail one at a time, and ultimately we had systemic failure of the system, the problem that the banks had was that they had problem loans that had been offered to consumers who weren't able to pay them back. And I can go into those problem loans if Bill asked me to go into them. But the short of it is that we had a lot of problematic loans in the system. And so the way to help the banks would have actually been to aim the subsidies at the consumers to allow them to maintain their homes. Instead, we aimed almost all the subsidies at the bank. We sent trillions, not billions. Most people focus on the $700 billion TARP as if that's the real bailout. The real bailout came from over $12 trillion, depending on whose estimates you're using, as much as $23 trillion if you're looking at the special inspector general for the bank bailout, came from the Federal Reserve, the FDIC, through loans, investments, and guarantees. Here's the problem with just bailing out the banks. The consumers are still failing on their loans. So as much as we're giving to the banks, the consumers are still failing, so they keep sending more and more problems to the banks. And it's one of the reasons why, as the bank bailout has continued and a lot of people are celebrating that they're now returning to profitability, lending is actually still falling because the banks are not healthy. And just one last thing, while we're celebrating sort of a return and putting the lags back into the banking system, we're en route to one of, if not the largest number of bank failures in American history this year. And in fact, the FDIC insurance fund is now depleted. And so we're still in a crisis mode simply because we haven't addressed fully the concerns and the challenges of those consumers who are going to foreclosure. And as long as we continue to have millions of foreclosures every year, we continue to have a real negative drag on the economy, as well as sending more toxic products to the banks.
What's the role of Fannie Mae and Freddie Mac in refinancing?
Well, they are playing a major role in the refinancing right now. They're part of the administration's new refinance program. And that program started off working really well. It is a very thoughtful and well thought out program on the refinancing. It allows you to refinance your home if you're as much as 125% upside down in your mortgage, meaning that your mortgage is valued at more than 125% of the actual cost of the home. And so that's a really solid program. The problem that we're facing in this market is not so much the refinances, it's those loans that are in imminent threat of default or that are actually already in delinquency heading to foreclosure.
You mentioned a second wave that is likely to come in 2010. How big is that?
It is a huge wave, Bill, and one of the big challenges is that we started with a lot of unfair and deceptive products aimed mostly at households who were just really not sophisticated about the market. And so when they were told how the mortgages work, which was not accurate in terms of how the housing market worked. You know, we didn't just all of a sudden wake up one morning and find 3-4 million people just reckless in America. Something happened systemically, and it was a lot of bad products were entering the system. Most of those first products that failed were tended to be for middle income and moderate income households who just weren't that sophisticated in the market. A whole new wave of loans are in the market now for people who had higher incomes and higher credit scores. They're called pay option ARMs, and they don't begin to reset until the middle of next year and into 2011. There's almost $200 billion worth of those loans outstanding.
$200 billion?
$200 billion. And they will reset from minimum payment to fully amortizing loans, such that the loan resets on those loans, when they reset, on average will be more than $1,000 a month. So that's $12,000 a year. So you can imagine there are lots of consumers, particularly in this environment, who are not prepared to step up to the plate to pay $1,000 more per month. And that's the crisis that's still waiting to happen, on top of the crisis we have right now.
Let's hear from Ben, who's a Republican in Lake Elsinore, California. Go ahead.
Hello.
You're on the air, Ben.
Yeah, I have a loan with Washington Mutual, and it was interest only. And so then Chase came in to take over WAMU, and I reappointed to get a loan. And they came out and went through all the rigmarole. And all I want to do was get a 30-year fixed and get a lower interest. And we had high scores on our credit, and we had a lot of income, and they refused me. Now, what do I do? And the appraisal was double of what I owed. What's my next recourse, or what can I do to get out of this interest only and get into a 30-year fixed with a lower interest rate?
Sure. So from what you're saying, you are a perfect candidate for the administration's loan refinancing program. I don't have the details on your file, so I can't tell you exactly why they would have turned you down. We hear stories like this all the time, so it's not surprising that people are getting the runaround rather than getting refinancing as well as loan modification. But here's what you can do. There's the United States Department of Housing and Urban Development. If you Google them, go to their homepage, they will have on that homepage, very prominent, they have loan modification and they have loan refinancing. They will explain the Making Home Affordable loan modification program and the refinancing program. Just read through that. It's very consumer friendly. You can tell immediately if you are eligible and if you qualify. And if so, it will give you instructions right there, including a telephone number as well as other websites to go to directly to get help. So just go straight to HUD.
Next up, Taylor. Good morning. Atlanta caller on our independent line.
Good morning. Thank you for CSPAN. I have two questions. The first question is, late last year, they were discussing a tax relief for those people who withdrew from their 401k program, retirement program, to sustain their mortgages, or to those who have taken from their retirement funds to just to sustain themselves from unemployment. Is there any discussion about tax relief for those people as far as the relief of penalties for early withdrawal 401k?
Now, you know, I had heard some discussions about that, and I'm one of a number of people who believe that some types of exceptions, given this extraordinary crisis, particularly for emergency issues such as dealing with a home, a loss of a job, or something like that. But I can honestly say I have not heard of any legislation that's actually passed or is being currently debated. But don't quote me or don't take that as a sign that it isn't being done. I know lots of people have been talking about that here in Washington, but it's just it's an issue those 401k plans and others that I just haven't followed.
The real estate industry, home market, makes the front page of USA Today. Their cover story, Can Home Market Bounce Back Without More Help? They write the year is ending on a bright note in terms of home sales. A brighter note that it began. Sales of existing homes are running at the highest pace in more than 2 years. Inventory of unsold homes is the lowest in more than a year, and home prices are falling at a much slower pace than they were this time last year. But economists caution that a good part of the improvement is tied to government assistance, low interest that stem from the Federal Reserve's heavy buying of mortgage securities. That credit has been extended and expanded to include some repeat home buyers for 2010. Tell us a little bit about the home market, not just the refinancing market, but the home market, and what sort of help you're looking for new home buyers.
Right. So I smile when I hear that the positive news is coming, because it's more positive news that's built on a host of federal subsidies that are just working their way through the system, coursing through the veins on the market in a way that just don't speak to sustainability. So, for example, you have a tax credit for new home purchases that's now being extended to purchases of homes for anyone, whether you're a first-time home buyer or you just want to buy a home in the market. And there's nothing wrong with these programs. Those stimulative types of programs are really powerful and important for an economic recovery. The question is, have you addressed the fundamental and underpinning problems that are negatively impacting the system, such that the stimulative now is putting you on the road to recovery? Or are you really just being put on a bridge that goes nowhere, because at the end of the stimulative you still have the underlying problems? The problem in this particular case is we're attempting to use stimulative programs to as a substitute for addressing the real fundamental problem. As long as you have 4 million people going to foreclosure, saying that you've got a lot of housing sales going, you have to ask yourself, well, what's happening there? And we're in the middle of a recession. Well, part of it is the stimulative aspects of low interest rates. Part of it is the tax credit. Part of it is that a lot of those homes are being sold at distressed sales, and so they're being sold at 40%, 50%, 60% of their value. That's not a healthy market.
San Mateo, California. Good morning, Valerie, Democratic caller.
Hello.
Hi, Valerie. Go ahead.
Hi. I was wondering why the banks don't volunteer to split their mortgages, like take the over part. Split the mortgage, like have an 18-year loan for half of the mortgage now because of the recession, and then the remaining 12 years collect the other part. Why do they think they can just, why do these consumers think they should just be off the hook for those amounts they borrowed? Couldn't the bank carry, say, a couple $100,000 for 18 years without a hitch?
Well, so your question sort of suggests two issues. One is you said something I thought about, why is it that consumers think they should get off the hook? And then would the banks be willing to do some unusual or supernormal things to modify the loan? So the answer is that the banks actually, it's an interesting thing. What's in the best interest of the banks and the investors actually is in the best interest of the consumers. Those two parties are different from the one who actually services the loans, who has a different financial incentive. And this has been the sort of the disconnect all along. So, for example, when homes are going to foreclosure now, what it's called loss severity in the industry, meaning that the lender or the investor is losing as much as 60% or more of the value of that home if it goes all the way to foreclosure, as opposed to having modified it and lost maybe 30% of the value of that home. In some cases, less than that. In some cases, maybe a little more. But in most cases, actually doing better than allowing it to go to foreclosure. So most people who've been studying this issue have been scratching their heads for the better part of the year, asking, why is it that these loans are going to foreclosure, costing such an extraordinary amount? And the answer is that you have a group of people who manage these loans called the servicers. And their incentives are different from the investors and the consumers, and they don't have a compelling reason to participate, because the law that would actually give them a reason to really be much more aggressive and assertive in modifying these loans hasn't passed Congress. And it's unfortunate because we're bailing out the financial industry, and we're even putting billions of dollars up now to help support consumers. But in fact, the law that could have one of the most powerful immediate effects would cost nothing to the consumers. We just can't get it past the bank lobbyists on Capitol Hill, which, by the way, are being paid for by the same financial institutions that the American taxpayer paid out. So in other words, the consumer stepped up to the plate, the taxpayers, bailed out the banks, and then the banks turned around and sent an army of lobbyists to Capitol Hill to work in opposition of the best interest of the same people who bailed them out. This crisis is going to be written about in textbooks and history books for years, and no one is going to believe how completely almost odd, strange, surreal has been this whole dealing with this crisis. The
president's meeting with bankers today at the White House. What are you hoping to hear from him regarding the mortgage market, regarding refinancing?
Well, I think we know what we're going to hear from him. We've seen a lot of previews, and that is he's going to pound that table and tell them they need to step up to the plate and do the right thing. The question isn't what he's going to say to them. It's what are they going to say to him? Because the fact of the matter is that the largest banks that receive the greatest subsidies are showing great profits. They're en route to getting near record bonuses, and at the same time, the lending, which was the whole purpose of bailing them out, has actually been dropping precipitously, like a rock, for months after month after month after month. And so what we need to hear from them is what are they going to do to actually contribute to the economy, which was the whole purpose in bailing them out. That's why I'm saying that a lot of people say, well, you know, the bank bailout was a success. Well, it's a success if we've ended the foreclosure crisis. It's a success if we're lending again that's putting the economy back to work. But it's not a success if the only thing that happened was we improved bank earnings for those institutions that were bailed out and allowed them to walk away with a lot of bonuses and leave the American public, working Americans, still in a lurch financially. That's not a success.
One more call for you. Keith here, Palm Bay, Florida. Good morning.
Good morning. I know this is the last call, but give me a minute here. You started hitting on it real good there for a minute. The economy seems to be built on an artificial basis, not a free market, you know, with these tax incentives and everything, the cars for clunkers, making people buy early and everything, and taking away the future sales. And until we reset and are allowed to fail, we're going to be in big trouble. It's like me taking out another credit card to pay off another credit card. You said earlier that the government's creating jobs, but it borrowed money to do this. And they say the average job's being created at a cost of $200,000 to create a $50,000 job, which then that person doesn't even pay taxes. So we're just perpetually putting ourselves deeper and deeper in the hole. I think you were right when you said, you know, it should be more of a buyer beware, because kids are graduating from school and they know the culture of different countries, but they don't know the difference between a fixed or adjustable mortgage. And I don't see why an adjustable mortgage was even allowed in the subprime. We used the subprime to pay off our credit. We got it at a high interest, and then after 5 years of living in it, used it to pay off our credit. And we used it in the right manner instead of spending it on vacations and stuff. I think it was both sides. It takes both sides to tangle, and it was the bank's fault for taking advantage of a lot of people, and it was a lot of people's fault for using their house equity as a piggy bank.
All right, Keith, thanks for the input.
And just a quick comment. I think that was a really insightful point, and I think the extension when you talk about public policy from what you said was really good, which was for every one of these transactions, a lot of people say, well, it was all the bank's fault, and then a lot of people say it was all the consumer's fault. Let's assume the reality that for every bad loan, there was a banker and there was a borrower. And so the point is, if you're going to bail out one side or the other, why not bail out the one that actually is going to bail out both sides, or at least be evenly distributed in the way you address the crisis? We haven't been equally distributed. We acted as if the banks were taken advantage of completely, and the consumers, all of the consumers were exploiting the banks, and that's been a big problem. Let me just say real quickly on the job side, The jobs that are created when you stimulate the economy, it's actually a very powerful tool to get the country back to work. The problem is you can't stimulate the economy while ignoring the fundamental problems underneath it. So you have to both do the stimulative things as well as address fundamental problems that caused the crisis in the first place. And that's something that we haven't done a good job on. And then the final part is just be aware that if the government creates jobs like the cash for clunkers, or even if they were to put people to work directly in public service jobs, those people would pay taxes. And putting people to work is the best and fastest way to bring down the deficits that we're having. So working America does work to bring down the deficits. And so I think if you're really concerned about the economy, we should be looking at two things, which is fundamentally addressing this foreclosure crisis and then fundamentally putting people back to work, not just with short-term stimulus, but what are you hearing in terms of the long term? Because this job crisis we have will last into 2010, into 2011. Doesn't mean we'll have growing unemployment into 2011, but it means the levels will be very high, at least 9% for at least the next couple of years, 8%, as much as 8% into 2013. That's not, most Americans won't accept that. It's not healthy, and we need to address those problems.
Jim Carr is the Chief Operating Officer for the National Community Reinvestment Coalition. You can read more about the organization at ncrc.org. Thanks for coming in this morning.
Thank you, Bill.
For the next half hour, we're going to pick up the conversation on jobless numbers, and in particular those of college graduates. The Baltimore Sun, a lead article on the front page, caught our attention this morning. Diploma falls off as ticket to a job. A Don Lee